feeling like retirement planning is this massive, overwhelming puzzle, you're definitely not alone.
Hmm.
Between figuring out, the right savings accounts, navigating all the investment options, and sifting through often conflicting advice, it's easy to feel completely
Yeah, that
lost.
feeling of overwhelm, it's something we hear about, like, all the time.
Right.
And it really just highlights the need for, clear information, digestible stuff.
And that's precisely what we do here at the Deep Dive. You, our listeners, you send us your sources, articles, research reports, whatever's caught your eye, and we do the heavy lifting.
We dig in.
We extract the crucial insights, the knowledge you need, without drowning you in information overload. Think of it as your shortcut to being, properly informed on the topics that matter most.
Our goal really is to provide that quick but thorough understanding, explore the different angles in the material you share, and hopefully spark some of those aha moments.
Yeah, those moments are great.
Yeah. Makes learning rewarding. Right?
Yeah.
All while being mindful of your time and, keeping the language pretty straightforward.
Today, we're diving deep into a topic that's, I think, top of mind for so many: investing for a secure retirement.
Mm-hmm. A big one.
And we're doing it based on excerpts shared by one of you from the 2003 book, Protecting Your Wealth in Good Times and Bad.
Right. And even though this book is, a couple of decades old now,
Yeah.
it still lays out these really fundamental principles of investing that, honestly, they stand the test of time.
Okay.
So our mission today is to pull out a clear and actionable understanding of those key principles for building retirement wealth, sticking really closely to what the book itself presents.
Got it. And right from the start, the book highlights three sort of basic investing mistakes people commonly make.
Yep.
It talks about trying to time the market perfectly, chasing after those investment fads that seem like they can't miss.
Oh, yeah.
And maybe surprisingly, paying too much for investment advice. We are definitely going to unpack all of those.
Absolutely. So maybe let's start with the foundational point the book makes really early on,
Okay.
which is the critical importance of actually investing your money after you've done the hard work of saving it.
Okay, let's unpack this. Because you'd think saving a good chunk of money would be the main battle, wouldn't you? Just setting aside those dollars consistently.
Saving is absolutely the essential first step, no question. You can't invest what you haven't saved, right?
Right.
But the book really hammers home that simply letting those savings sit, especially in low-interest accounts, isn't going to cut it for building a truly secure retirement nest egg.
Especially with inflation eating away at it over time.
Exactly. Inflation's the silent killer there.
The book points out that unfortunately as a nation, we aren't always doing a great job with that second part, the strategic investing piece.
That really hits home. I know so many people who are disciplined savers but just feel completely overwhelmed, almost paralyzed when it comes to figuring out where to put that money so it can actually grow. And that paralysis leads us right into the first big mistake the book identifies: trying to predict market timing.
Ah, the classic, should I jump in now or wait for a dip question. We all wrestle with that one.
Constantly. The book uses the market volatility around the turn of the millennium, that bull market, then the bear market around 2000 to 2002.
Yeah, I remember that roller coaster.
Right, as a prime example of just how incredibly difficult, maybe impossible, this is to do consistently. And it makes a really insightful point. Markets often look most attractive, drawing in the biggest crowds.
Right, when they're riskiest.
Exactly. At the very moment when they're actually at their most risky.
That's where it gets really tricky, doesn't it? Because when things are booming and everyone's talking about making money, that FOMO, fear of missing out, it really kicks in hard.
It does. But the book suggests trying to time those peaks and troughs consistently. It's ultimately, a fool's errand.
So nobody really has a crystal ball.
Nobody. Not even the so-called experts can reliably predict these short-term swings again and again.
Okay, so mistake number one, leave the crystal ball on the shelf. Got it. What's the second big pitfall the book warns us about?
The second mistake is very closely tied to the first one: chasing hot investment fads.
Right, the shiny objects.
Exactly. This is that tendency to see an investment that's recently delivered, like exceptionally high returns, something generating tons of buzz.
Yeah, this stock is on fire, or the next big thing you have to get into.
Those headlines, yeah. And you jump in thinking that rapid growth is just going to continue forever. The allure of getting rich quick is powerful.
Very tempting.
But the book offers some maybe counterintuitive wisdom here.
Okay.
If an investment has already generated huge profits recently, that often signals a time to think about selling, not buying in at what could be the top.
Huh. So high recent returns aren't necessarily a green light.
Not a guarantee of future success, no. In
Mm,
fact, sometimes they're a red flag. Could mean a correction is coming.
that makes perfect sense looking back, but boy, it's easy to forget that logic when you're caught up in the excitement, isn't it?
It really is. Human psychology plays a huge role, which we'll get into a bit later. But for now, the key takeaway from the book is be very, very cautious about chasing the latest shiny thing in investing.
Okay. Avoid market timing, resist chasing fads. What's the third major mistake the book warns about?
The third big one is paying too much for investment advice.
Ah, the fees.
Exactly. The book argues that high-cost advice is surprisingly common, and often the quality of that advice doesn't really justify the high fees being charged.
You mean those, like, hefty commissions or ongoing management fees?
Precisely. And the book emphasizes a really critical point. Every single dollar you save on commissions and other fees, it goes directly to your bottom line.
Boost your actual returns.
Right, boosts your overall returns over the long haul. It draws a really clear contrast between high-cost options and lower-cost alternatives, and strongly advocates for embracing those low-cost options as a core principle.
So when it comes to investment fees, less is definitely more.
Absolutely. And this leads us straight into a central recommendation in the book, the huge power of keeping fees low. Specifically, its strong advocacy for investing in index funds.
Index funds. Okay, for anyone listening who might not be totally sure what those are, could you give us the quick rundown?
Sure. Simply put, index mutual funds are designed just to track the performance of a specific market index.
Like the S&P 500.
Exactly, like the S&P 500,
Right.
which represents a big slice of U.S. stocks, because their strategy is just to mirror the index, not try to beat the market by actively picking stocks.
They don't need as much active management.
Right, so they generally have significantly lower operating expenses, those fees we were just talking about,
Yeah.
compared to actively managed funds where a manager's making buy-sell decisions.
Okay.
The book flat out states that keeping fees low is the single most important thing to look for in mutual funds.
Wow, single most important.
Yeah, and that index funds, because they just match the market, typically offer the lowest fees you can find.
So instead of paying a manager a higher fee to try and pick winners, you're basically buying a tiny piece of everything in a specific market, but at a much lower cost overall.
That's a great way to put it. And the book makes a really compelling case that over the long term, those lower fees often mean better net returns for you, the investor.
Compared to higher cost active funds where the manager's skill might not consistently overcome that fee disadvantage.
Exactly. It's a big hurdle for active managers to clear consistently.
Now, beyond just stocks and bonds inside mutual funds, does the book touch on other kinds of investments people might think about for retirement?
Yeah, it does briefly touch on several other areas relevant to building wealth. It has a chapter discussing things like owning your home, investing in other types of real estate,
Like rental properties.
right, also starting or running a small business, and even how to handle stock compensation you might get from your employer.
Interesting. So a more kind of holistic view of different ways to build wealth that contribute to retirement.
Exactly. But after covering those different investment types, the book really shifts into what it sees as the critical concept of asset allocation.
Asset allocation, okay, that's about dividing your money among different investment categories, isn't it? Stocks, bonds, maybe real estate.
Yes, precisely. It's that strategic approach of building your portfolio by splitting your investments across different asset classes, stocks, bonds, maybe others, based on things like your risk tolerance, how long until you retire, your goals,
So it's less about picking the perfect stock.
and more about the overall mix. The book stresses the importance of asset allocation so much, it actually dedicates a whole chapter just to explaining how it works in detail.
So it's not just what you pick, but fundamentally how you strategically divide your money.
That's the core idea. And after that discussion, the book tackles the often tricky question of understanding expected returns.
Yeah, what kind of growth can you realistically expect?
Right. It acknowledges forecasting market returns is never easy or precise, but it does dig into methods and historical data to give you a framework for thinking about what you might anticipate long term.
Now, the book is structured around different life phases for saving and investing, isn't it? It's not just a one-size-fits-all plan.
That's right. Part 3 gives this lifelong guide, broken into 4 distinct phases: early savers, midlife accumulators, pre-retirees, and retirees, and finally experienced retirees.
Okay.
And each phase gets its own chapter with tailored tools and advice for the specific challenges and opportunities you typically face at that stage.
That sounds really practical, structuring advice based on where you are in your career and how close you are to retirement.
It is. And while there's good stuff for all phases, maybe let's zoom in a bit on the pre-retirement phase.
Okay.
That's often when people get really focused on locking down their financial security for the upcoming retirement years. The book defines this as starting about 5 years before you plan to retire.
Gotcha. Those crucial final years of prep before stopping full-time work.
Exactly. During this pre-retirement phase, the book really stresses the need for detailed financial plans, like mapping out your expected income and your anticipated expenses in retirement.
Getting specific.
Very specific. It explains how you should start strategically adjusting your investment portfolio to generate the income streams you'll need to replace that paycheck.
Right. Shifting focus a bit.
And importantly, it highlights the increasing need to prioritize risk avoidance, gradually reducing the amount of equity, stock market holdings in your retirement accounts as you get closer to needing that money.
Makes perfect sense. You don't want to be too exposed to big market drops right before you plan to start living off those savings.
Precisely. You want to lock in some gains and reduce volatility.
Mm.
The book also touches on the big issues people face as they transition into retirement, like figuring out Social Security benefits, understanding Medicare and Medigap options for healthcare.
That maybe even selling the house.
Yeah, considering whether selling the primary residence fits into the overall financial picture.
Now, the preface of a book often really sets the tone. What are some key takeaways or overarching ideas the author lays out right at the beginning of protecting your wealth?
The preface hits a couple of really crucial points. First, it strongly emphasizes there's no single, universally perfect retirement plan.
One size doesn't fit all.
Exactly. The book is meant as a guide to help you, the reader, find and implement the best path for your own unique needs, circumstances, goals. It makes a great point that a well-thought-out plan you actually act on
Is better than a perfect plan you never start.
way better. Action, the book says, is what truly makes a difference.
I really like that. Sometimes we get so caught up trying to find the absolute perfect strategy that we just delay and delay.
Analysis paralysis, right?
Hmm.
The second key point from the preface is that this book should be seen as just one important piece of a larger, lifelong commitment to self-education.
Learning about finance doesn't stop.
Never stops. Aiming for long-term financial security requires ongoing learning. It even includes a helpful appendix listing other recommended books for digging deeper.
So it's not the final word, but a really solid foundation to build on.
Precisely. Now, shifting gears a bit, the book does delve into the often discussed and somewhat worrying state of the Social Security system here in the U.S.
Oh, yeah, the big question mark hanging over future retirees.
The book points out that Social Security benefits have actually been cut or adjusted downwards multiple times already, specifically in 1977 and 1983 through legislative changes.
Okay.
And it suggests further significant cuts are quite likely over the next couple of decades, especially as the large baby boomer generation continues to retire.
Uh-huh. More strain on the system.
Yeah. It even raises the serious concern that if policymakers don't take further action, the program could potentially face a situation where it can't pay out full promised benefits for people born after 1960.
Wow, that's a pretty sobering thought and a major worry for a lot of folks.
It is. The book outlines a couple of politically unpopular but likely necessary solutions that have been proposed. Gradually raising the full retirement age to 70 and implementing an overall benefit cut of around 30%. It argues these kinds of big changes would probably be needed to align the system with longer lifespans and ensure it's financially sustainable long term.
So it sounds like there are no easy fixes when it comes to the future of Social Security. What about that idea you sometimes hear about turning the trust fund over to individuals to invest privately?
The book expresses some skepticism about that idea.
Why's that?
Well, first, it points out there isn't actually a big pile of cash just sitting in the trust fund waiting to be handed out.
Oh.
Essentially, the government has used surplus contributions over the years for general operations, issuing IOU special treasury bonds back to the trust fund.
Okay.
So the book suggests that in the future, when the government needs to start repaying these bonds to fund benefits, it could actually put more strain on the federal budget deficit.
Huh. So it's much more complicated than just divvying up a cash fund.
Exactly.
Yeah.
Now, another angle people think about long-term is what they might leave behind for kids or other heirs.
Right, the inheritance question.
The book touches on this. It observes that while some folks might initially say, oh, I don't plan to leave anything, The reality is most people do end up leaving something.
Yeah, that seems true.
So then it raises the question, is it better to gift money or assets during your lifetime or leave it as an inheritance?
Okay, pros and cons.
The crucial point the book makes is that any gifts you make while you're alive shouldn't negatively impact your own standard of living or financial security in retirement.
You've absolutely got to secure your own oxygen mask first.
Precisely. And that ties directly into what the book says is the primary financial worry for most people heading into retirement.
Which is
The fear of not having saved enough, of running out of money during retirement.
big one.
Yeah. This fundamental concern, the book suggests, is what ultimately drives how much you can safely withdraw from your accounts each year without risking your long-term security. It hints this safe withdrawal rate idea will be explored more later when discussing portfolio management in retirement.
So the main goal is making sure those savings last the distance. Now, the book also presents some really interesting, maybe even surprising, data on how well the average worker's retirement savings have actually performed.
Yes, it does. It uses a chart, figure 2.1, with data from the Nebraska retirement system up to the end of 1999.
Okay.
And it shows that on average, individual workers managing their own 401ks earn significantly lower returns compared to professional money managers handling part of the state's bigger pension fund.
Lower than the pros, maybe that's expected, but
But maybe more surprisingly, the average worker also underperformed a simple static mix of like 45% stocks, 45% bonds, and 10% cash. Just a basic unmanaged portfolio.
wow, that's a pretty big difference. Why does the book think that happened?
Well, it asks, were employees lacking information? Do they have poor investment choices in their plans?
Right.
But then it points out, specifically in that Nebraska system, workers actually got a lot of educational material. They were offered paid time off to attend free investment seminars on retirement planning.
So they had the resources.
They seemingly had the resources and education available. But despite all that, the average worker still managed to significantly underperform both the pros and that simple asset mix.
So it wasn't just a lack of information causing the poor results?
Apparently not. The book then cites a big 2001 study from the National Center for Policy Analysis. They looked at hundreds of 401k plans, thousands of participant accounts.
And what did they find?
Their conclusion was emphatic. Across the board, individual workers, especially lower-income ones, consistently underachieve the market's performance in their 401ks.
Even in good market years.
Yeah, they looked at 1998, a really strong year for stocks. The average 401k return was just 8%. But that simple 4 or 5, 10 mix we mentioned, that would return 18% that year.
That is a huge gap, 10 percentage points. It really makes you wonder what's driving that underperformance.
It does, and the book starts pointing towards behavioral factors. The way our own psychology and biases can sometimes lead us to make less than great investment decisions. We'll definitely dig into that more later.
Speaking of advice, the book also seems pretty critical of the kind of investment tips you often get from the mainstream media.
Absolutely. It critiques that common buy this, sell that advice you see everywhere, media outlets, paid ads from Wall Street firms. It points out how inconsistent it often is.
Yeah, one month it's tech stocks, the next it's something totally different.
Exactly. Hot tips change constantly. The book asks a really sharp question. If this widely available advice was so effective, why did so many people lose significant money between 2000 and 2002 when the market turned down?
That's a really fair point. If following the headlines worked, wouldn't a lot more people be wealthy from it?
You'd think so.
Yeah.
This line of thinking then leads into a really illustrative and kind of cautionary story the book shares about a barber named Ed.
Ooh, tell me about Ed. This sounds like a classic example.
So Ed was a barber. During the late 90s tech boom, he started hearing his customers talk a lot about investing in tech stocks, especially those new internet companies. And even though his gut initially told him to avoid picking stocks, Ed started wondering if he was missing out on a big chance to retire way earlier than planned.
The temptation.
Right. So in 1999, based on a tip from a stockbroker client, Ed made his first tech stock investment.
Uh-oh. I feel like I know where this might be going.
It turned out that way.
Yeah.
After some surprising early wins, fueled by more encouragement and stock tips from his broker client, Ed decided the interest on his safe bank CDs just wasn't cutting it anymore.
Ditch the safety net.
Yep. Started pulling money out of conservative stuff and putting bigger and bigger chunks into various tech stocks. Over the next 6 months or so, he was actively trading tons of stocks recommended by his broker and others. He even started using trading jargon, put a monitor in his shop to watch quotes.
Wow, went full trader mode.
Totally. Spent evenings analyzing charts, looking for breakout patterns, joined online chat
That
rooms.
sucked right in.
He really did. By early 2000, the book calls him a day trading maniac, constantly watching, buying, selling. He was convinced his method was refined, very little risk of loss.
Peak overconfidence.
Absolutely. The author even recounts Ed spending an hour in the barber chair right near the tech market peak, explaining his complex system and telling the author he should use Ed's method for his own clients.
Oh, wow. You can just see the cliff approaching.
Sadly, yeah. Ed had basically arrived at the party just as the lights were about to go out. He almost hit $1 million in his portfolio,
Almost.
before tragically losing over 60% of his entire retirement savings in the next 20 months as the tech bubble burst and the market tanked.
Oh, man. 60%.
Yeah, needless to say, his early retirement dreams shattered.
Yeah.
He couldn't retire at all. But despite this, Ed remarkably kept blaming his broker.
Still didn't see his own role.
Nope.
Yeah.
Maintained his profitable picks were his own genius. All the losers were the broker's fault. Regretted not firing him sooner.
Wow. What a powerful and, heartbreaking story. So, according to the book, what was Ed's real fundamental mistake here?
The book is crystal clear. Ed's biggest mistake was completely abandoning his original sensible, sound, long-term investment plan.
The CDs and the diversified stock fund?
Exactly, that initial plan. The book strongly suggests if Ed had just stuck with that prudent, patient approach, he likely would have been perfectly fine, ready to retire comfortably as planned.
But the lure of quick riches.
Yeah, his impulsive, ultimately disastrous detour into speculative day trading completely derailed everything, devastating losses.
That's just such a potent reminder about sticking to a sound, long-term strategy. Now, Ed's story seems like a perfect illustration of some behavioral finance principles. What does the book say about how our own psychology messes with our investing?
Ed's experience is, a textbook example of how our human behavior and psychological tendencies can inadvertently sabotage our best investment intentions.
We get in our own way.
Often, yeah. The book introduces behavioral finance as the study of how our biases and emotions affect our investment decisions and ultimately our portfolio performance. It highlights that we're often our own worst enemies. We develop warped perceptions of our abilities, act irrationally.
Seeing patterns that aren't there, maybe.
Exactly. Or letting wishful thinking and overconfidence cloud our judgment.
So it's about understanding those common mental traps we fall into as investors.
Precisely. The book specifically mentions the work of Richard Thaler, a pioneer in behavioral finance.
Right. Nobel laureate.
Yep. His research explored a whole range of seemingly irrational behaviors, from buying lottery tickets with terrible odds to making super speculative bets with retirement savings.
Why do we do that?
Thaler suggests overconfidence is a big one. The average person tends to think they're significantly above average in many things.
Including investing skill.
Including investing skill, yeah.
I can definitely see that.
Yeah.
We all like to think we're a bit smarter than the next person.
Exactly. And this often unwarranted overconfidence leads to bad behaviors. Trading too much, taking on way too much risk for their situation, underestimating the chance of losses.
Makes sense.
The book also mentions our innate human love for finding patterns, even in random data, like seeing trends in stock charts that aren't really predictive.
Right. Thinking past performance guarantees future results.
Which leads to overreacting to perceived trends that might just be short-term noise. The classic buy high, panic, sell low, driven by emotion, not logic.
Definitely seen that happen.
The book also shares some interesting research findings, like how people are way less likely to sell stocks they inherited.
Was that inertia?
Sort of an inertia bias, yeah. They assume mom or dad bought it, must be good, even when diversification would be much smarter financially. The author mentioned seeing heirs suffer big losses by failing to diversify those inherited holdings.
That emotional connection can be strong, hard to let go.
It can be. The book also briefly mentions the Beardstown ladies case.
Oh, yeah, I remember them. The investment club.
Right. They presented themselves as experts with amazing returns. But later analysis showed their reported returns were unrealistically high compared to the stocks they actually held.
Were they lying?
The author suggests they probably genuinely believed they were outperforming the market rather than intentionally deceiving anyone, which just highlights how easily we can convince ourselves of our own brilliance even without objective proof.
It's a really important reminder to always check the facts and try to stay objective about our own performance and abilities.
Absolutely. And for anyone listening who wants to dive deeper into behavioral finance, the book specifically recommends Larry Swedrow's book, Rational Investing in Irrational Times.
Okay.
It apparently lists like 52 common investment mistakes people make, all backed by academic research.
Sounds like a valuable resource for understanding our own investment psychology better. Now, another fundamental market reality is the inevitable bear market. What insights does the book offer on those downturns?
The book uses historical data, 1903 to 2002, to show just how relatively common bear markets are.
More frequent than we might think.
Yeah, for instance, it points out there were 42 separate one-year bear markets during that long period.
Wow, 42.
Right. It explains that during long bull markets, those extended periods of growth, it's easy for investors to get complacent, to forget the inherent risks.
The "this time it's different" syndrome kicks in.
Exactly. People start believing the old rules don't apply, the good times will just roll on forever.
We definitely saw a lot of that "this time it's different" thinking during the dot-com boom.
We sure did. The book describes how during the long bull run from 82 to 99, certain high-flying growth stocks seemed like guaranteed moneymakers,
Uh-huh.
leading the public to eagerly buy these often risky assets and the mutual funds holding them. This behavior, the book notes, was often actively encouraged by Wall Street firms.
Why is that? More trading.
More trading, higher revenues for them when people are buying and selling stocks compared to passively holding bonds.
So there's kind of a built-in incentive in the industry to promote more active stock trading.
Seems that way. Mutual fund companies, insurance firms selling investments, financial magazines, TV shows, anyone benefiting from more public stock market participation generally cheer the rising market on.
Right.
But the book serves as that timely reminder. Bear markets aren't weird exceptions. They're a natural, recurring part of the cycle.
What about how investors have actually behaved during past market cycles? Does the book give any historical perspective there?
Yeah, it does. It notes that after the market bottomed out in 1974, the S&P 500 had strong returns from 75 all the way through 92. Way better than safe bank CDs.
Okay.
But despite that strong performance, experienced investors back then often preferred the perceived safety of FDIC-insured deposits. Stock ownership actually declined for a while.
Huh. Interesting. They were still cautious after the 74 crash?
Seems so. It wasn't until the early 90s that a new wave, the baby boomers entering their prime earning years, really started entering the stock market in big numbers.
Fueled by more info and mutual funds.
Right. Better access to information, more fund options. This led to a big jump in household stock ownership from 33% in '89 up to 52% by 2001, largely driven by employer plans like 401ks becoming more common.
It seems like each generation kind of has its own market experiences and attitudes.
It does seem that way. But the book consistently repeats that trying to time these cycles, increasing stocks in bull markets, decreasing before bears, generally isn't a winning long-term strategy for most people.
So back to not timing the market.
Exactly. It strongly advocates for a more disciplined, consistent approach. Decide on a long-term target asset allocation, that mix of stocks and bonds fitting your goals and risk tolerance, and then stick with it
It's for thick and thin.
through all the market's ups and downs.
That steady approach seems like a core theme. Now, the book specifically mentions a TIAA-CRF study on investor behavior during that late 90s bull market. What were the key findings there?
Right. This study looked at retirement saving habits of public service employees, teachers, university staff, folks like that. They tracked how people's allocation to stocks changed over time as they aged and how the bull market affected their strategies. The findings show that from 87 to 94, TIA-CREF participants gradually got more comfortable with equity risk. But starting around 95, there was a noticeable acceleration in stock allocations across almost all age groups.
People piling in more aggressively.
Yeah, both with new contributions and money already invested. By 99, for example, people who were 44 back in 87, so 56 by 99, had significantly upped their stock holdings from around 42% on average up to about 57%.
So as the market kept climbing, people got increasingly comfortable putting more and more retirement money into stocks.
Exactly. It really highlights that common human tendency. We get more comfortable with risk after we've seen good returns for a while. But then, of course, the market eventually turned.
What did the book say about how those same investors reacted to the big 2000-2002 bear market?
It describes how individual investors, mostly, reacted by pulling back. and in many cases finally getting a clearer sense of their true risk tolerance, which they'd maybe overestimated during the bull market euphoria.
Reality check time.
Big time. Day trading, which had become so popular,
Yeah.
it saw a huge decline as many people lost substantial amounts of money. For a lot of investors, this was their first real painful bear market experience. Many didn't really understand what went wrong or how to fix it.
Sounds like a painful but maybe necessary learning curve for many.
It certainly seems that way. And the chapter on bear markets concludes by repeating, while downturns hurt, especially if you're over-risked,
Yeah.
the real danger often lies in the overly optimistic, sometimes irrational behavior and risk-taking that happens during the late stages of the preceding bull market.
So the euphoria is the dangerous part.
That's what the book argues. It stresses again, you can't predict downturns. The key is having a solid, long-term, diversified plan and sticking to it, resisting that temptation to abandon diversification and chase risky assets when everyone else is getting greedy.
That message of staying the course, long-term perspective, it really is a constant thread, isn't it? Now, the book also mentions something counterintuitive. Investors often underperform even the mutual funds they own. How does that happen?
It is a bit weird, right? Figure 4.2 in the book shows data from a Money magazine study, 98 to 01.
Okay.
It revealed that, on average, individual investors in U.S. stock funds earned returns several percentage points lower than the average returns of the actual funds they were invested in.
That's fascinating and confusing. If they own the fund, shouldn't their return match the fund's return?
This underperformance is largely blamed on those behavioral issues again.
Ah, buying high, selling low.
Exactly. People tend to chase past performance. They buy after a fund has had strong gains, often near its peak, and they tend to sell after it's already dropped significantly, often locking in losses.
So our own actions hurt us.
This pattern of buying high and selling low, driven by emotional reactions, eats away at their returns compared to just holding steady in the same fund long term.
So our attempts to be clever about getting in and out often backfire.
Often, yes. The book also briefly touches on potential gender differences. It mentions research finding men tend to have lower investment returns than women,
Really? Why?
partly attributed to things like greater overconfidence among men, maybe leading to more frequent trading.
Interesting. So maybe a less active, more patient approach pays off. The book also mentions mutual funds having distinct styles that go in and out of favor. What does that mean for us?
Right. Most stock funds follow a style, like growth investing, focusing on high growth potential companies, or value investing, looking for undervalued companies.
Yeah.
When one style significantly outperforms the other for a while, that usually drives a fund's relative performance. The book says a fund style should be clear in its prospectus.
But sometimes isn't.
Yeah, and that some fund companies aren't always as transparent as they could be about this.
So understanding a fund's style helps explain its performance swings relative to the market.
Exactly. But the book highlights a very consistent finding across studies, constantly switching between popular investments trying to chase returns, what it calls roaming with the herd,
Doesn't work.
almost always leads to below-average results overall. It suggests this damaging behavior is driven by that desire for higher returns and also wanting to quickly ditch losing investments. Psychologists call it cognitive dissonance, avoiding acknowledging past mistakes.
Makes sense. Nobody likes admitting they picked a loser.
Right. The book tells a funny story about this. A stockbroker had a client falsely claiming his State Street Aurora fund was crushing the SPDRs, the S&P 500 tracker.
But it wasn't.
No, the claim was totally baseless. The Aurora fund was brand new. The client wasn't even a State Street employee. It's just an example of how we can convince ourselves of things to feel better about our choices.
Denial can be strong when money's involved. The book also looks at growth versus value stocks around the turn of the millennium. What did that show?
It uses charts to show growth stocks creamed value stocks from late 97 to March 2000, right during the dot-com peak.
Uh-huh.
Then it shows how investors reacted by pouring money into growth funds, especially late 99, even pulling money out of value funds to chase that growth trend.
Following the herd again.
Exactly. But then, after the bubble burst, the trend totally reversed. From March 2000 to June 2002, value stocks significantly outperformed growth stocks.
So the folks who chased growth at the peak likely got hammered when it reversed.
Precisely. Another clear example of how chasing recent performance often leads to buying high and potentially selling low.
It keeps coming back to that.
The book also shares a story about the Mundernet Net Fund, launched late 96, to invest only in internet stocks.
Wow, niche.
Very niche. The author recalls being skeptical even back then, feeling internet stocks were already way overvalued. And while the fund did suffer huge losses later,
Yeah.
the book points out how industry performance measurement can be tricky. It cites a positive annualized return for the fund since inception from Morningstar's database, despite the later crash.
So performance data can be presented in ways that look better than the reality for many investors who bought later.
Exactly. It's a reminder to look critically at performance numbers in context. The book also briefly notes that the choice between U.S. stocks and international stocks is another big factor causing performance differences.
Right. Sometimes U.S. leads, sometimes international.
Yeah, U.S. stocks are about half the global market. Returns aren't synchronized due to different economic and political factors. It mentions historical shifts in demand. Japan, late 80s, emerging markets, early 90s, Europe, late 90s, showing investors often chase the hot geographic region.
That hunt for the next hot international market.
It's a common tendency.
Yeah.
But the book concludes, since predicting which fund type or region will outperform is basically impossible,
Yeah.
the best long-term strategy is a well-diversified portfolio with a mix of everything, growth, value, U.S., international, sticking to a consistent allocation that fits your goals and risk tolerance.
Diversification and staying the course. The core messages keep returning. Now let's circle back to fees. The book really emphasizes their impact.
It absolutely does. There's a section called the high cost of low returns. It uses a table to show the huge difference even a 1% change in annual return makes over a long savings period.
How big a difference?
In the example, it could boost your total savings and sustainable retirement income by like 32%.
Wow, just from 1% difference in return.
Yeah, which leads to the question, why would anyone knowingly accept lower returns unless they're unaware of the costs they're paying?
And the book argues people are often unaware.
Strongly suggests it. Typical investors often don't know the full extent of fees. Many costs are hidden or hard to quantify easily.
Like in 401k.
Yeah, the author mentions seeing large 401k plans showing investment options and returns, but failing to clearly disclose the associated fees and expenses. So people pick funds based on past returns or recommendations, not understanding the fee drag.
That lack of fee transparency is a big problem.
Huge. The book states most actively managed funds charge over 1% a year in expenses before any sales commissions. It cites Morningstar data from Decedical 2002 showing the average expense ratio across almost 15,000 funds was 1.40%.
Okay, 1.4%. How does that compare to low-cost options?
It contrasts that sharply with Vanguard, whose average expense ratio then was only 0.27%. That's a difference of 1.13% per year.
Which adds up massively over time.
Massively. The book argues most active managers just can't consistently overcome that fee disadvantage through stock picking. So long-term low-fee funds tend to deliver higher net returns.
Those small percentages really compound and erode growth over decades.
They really do. The book then gets into what it calls the business of distributing financial products, asserting many firms, especially traditional brokerages, are primarily in the business of selling products for profit, not necessarily giving impartial advice focused solely on the client's best interest.
Conflicts of interest.
Right. It mentions the incentives for brokers to sell high-commission products, which can unfortunately lead investors to own high-fee, like 1.4% funds, when comparable low-fee, like 0.3% options exist.
It definitely sounds like a potential conflict built into that sales model.
Absolutely. The book further points out when you add other costs, advisor fees, variable annuity expenses, administrative fees, total annual expenses can easily hit 3% or more.
3% a year off the top. Ouch.
Big ouch. It argues while these high fees might have been easier to ignore during the booming 80s and 90s, they'll be a huge drag in potentially lower return future decades. It even quotes Bill Bernstein warning many 401k investors might get near zero real returns due to low equity returns, high expenses, and poor planning.
That is a really stark warning for anyone counting on their 401k. The book also seems to touch on some questionable industry practices.
Yes. It highlights Wall Street firms creating and aggressively distributing questionable investments, often mainly to generate big profits for the firm.
At the expense of clients sometimes.
That's the implication. It mentions the large fines paid by major firms in 2002 for misrepresentation and fraud, but suggests these fines are often much smaller than the profits made selling the problematic stuff.
And the fine money goes to the government, not the harmed investors.
Often, yeah, which is frustrating.
It paints a pretty cynical picture of parts of the financial industry.
It does raise serious concerns about conflicts and the need for caution. The book also tackles incompetent or underqualified advisors.
Oh, so?
It notes that in the surreal world of investment advice, almost anyone can claim to be an expert. It asserts, alarmingly, many calling themselves advisors might lack basic financial knowledge.
Titles don't mean expertise.
Right. Titles like VP at brokerages are often based on sales, not expertise or training. The book then discusses widespread inadequate training, leading to bad advice, misrepresentation, ethical lapses. It notes the rising number of complaints and claims against advisors, often alleging unsuitable investments or breach of fiduciary duty.
So it really emphasizes the need for investors to be super careful, vet advisors thoroughly, and ultimately take responsibility for their own decisions. What about the role of financial journalists in all this?
The book quotes Warren Buffett criticizing journalists for promoting the "this time it's different" narrative during bubbles.
Wait, would they do that?
The book suggests media outlets are heavily supported by advertising from the investment industry itself, which could subtly influence their content and angles.
The hand that feeds.
It even shares excerpts from an anonymous Fortune article, Confessions of a Former Mutual Funds Reporter.
Oh, what did they confess?
The author admitted that while writing articles recommending specific hot funds, they personally invested their own money in sensible low-cost index funds, and confessed feeling pretty ignorant about finance early in their reporting career.
Wow. That's quite revealing and unsettling from someone influencing so many people's decisions. Makes you question the objectivity sometimes.
It certainly does. The book gives more examples of dubious expert and questionable recommendations, like Wade Cook Financial Corporation, whose stock-picking handbook the author was skeptical about, given the company faced an FTC hearing and had poor performance.
Okay.
And it recounts the Henry Blodgett story, the famous Merrill Lynch analyst, publicly bullish on failing internet stocks while privately trashing them. Huge conflict of interest.
Right, the emails came out.
Yeah. The book even quotes veteran investor Miller bluntly advising to avoid reading Barron's because it teases investors with short-term opportunities best avoided by long-term players.
So really, a healthy dose of skepticism is essential when consuming financial media and following guru advice. The book also dives into the world of mutual fund marketing. What follies does it describe?
It calls mutual fund marketing a high-stakes game, where companies often use various tactics, some ethically gray, to make their funds look good.
Because there are so many funds.
Thousands. Impossible for individuals to track effectively on their own, which makes fund evaluation services like Morningstar seem really important.
Right, the star ratings.
Yeah, Morningstar assigns star ratings based on past risk-adjusted performance, 3+ years. 5 stars is top, 1 star is bottom, like hotel ratings. But the book describes tactics active fund companies might use to potentially dress up performance metrics, even if not strictly illegal.
Oh, like what kinds of tricks?
It describes 3. First, incubator funds.
Incubator.
Small private accounts where companies secretly test new strategies.
Yep.
If one works, they launch a public fund touting the strong, early record. Unsuccessful ones, quietly shut down, poor records hidden. The book mentions one firm had 19 funds in incubation, with a high failure rate for those actually launched later. Second, Me Too funds.
Me too.
Funds rushed out to capitalize on a currently hot style or sector, often appearing just as that bubble's about to burst. They tend to close or merge within 3 years as performance fades.
Chasing this trend again.
And third, priming the pump.
What's that?
Strategically loading a new fund with hot IPOs or favorable deals to inflate initial returns and get a high early Morningstar rating. This attracts big money from investors.
And then performance often fades.
Yeah, as the fund gets bigger and those initial advantages disappear, it uses the Mundernet net fund again as an example of this rise and fall.
So investors really need to look past just the headline star ratings and dig deeper.
Absolutely. The book then makes a key point about information, quoting Bernard Baruch, something that everyone knows isn't worth knowing. It asserts financial advisors, the media, even fund companies don't have secret superior information or skill guaranteeing market-beating returns. And neither do your friends, relatives, or coworkers offering tips.
So it's basically a level playing field in terms of truly predictive information. That brings us to the practical side. Retirement savings plans. The book covers different options, right?
Yes, it gives a good overview of key retirement savings vehicles. Starts with the advantages of pre-tax accounts, like a traditional 401k.
Contributions reduce current taxable income?
Right. Though the money's taxed on withdrawal and retirement,
Yeah.
it notes annual contribution limits, potential penalties for early withdrawal before 59 and a half. And required minimum distributions, RMDs, starting at 70.5.
Those immediate tax benefits are appealing. What about employer plans like 401k specifically?
Explains they're common in for-profit companies with similar plans for nonprofits, 403bs, and government workers, 457s. Describes typical investment options inside fixed income, stock bond funds, maybe company stock. Mentions the contribution limits back then, 12K in '03, rising to 15K by '06. And highlights a key hidden benefit, tax-deferred growth. Your full pre-tax contribution works for you without being immediately taxed.
That compounding on the pre-tax amount over years really adds up. What about individual retirement accounts, IRAs?
Summarizes traditional IRA advantages, potential tax deduction on contributions depending on income coverage, tax-deferred growth, and penalty-free withdrawals before 59.5 for higher ed or first home purchase, up to 10K limit then.
Okay. And Roth IRAs?
Lists Roth benefits, tax-deferred growth, and crucially, tax-free earnings on withdrawal after 59.5 if account held 5+ years. Notes income limits for contributing. Suggests Roth might be great for younger workers in low tax brackets now, especially without an employer match.
Tax-free growth and withdrawal is powerful.
Very powerful. It also briefly mentions personal annuities funded with after-tax money, offering tax-deferred growth, but withdrawals taxed as ordinary income, growth first.
So a diverse landscape of options, each with different tax rules. Does the book suggest how to prioritize funding them?
Yes, gives a clear step-by-step guide. First, contribute enough to your employer plan to get the full match.
The free money.
Absolutely, don't leave that on the table.
Yeah.
Second, if possible, fund the employer plan up to the max salary deferral limit. Third, if still eligible for pre-tax contributions, consider traditional or spousal IRAs. Finally, consider Roth IRAs, especially if you expect higher taxes later.
Makes sense. Grab the match first. The book also has a summary table comparing these plans.
Yep, Table 7.1. Super useful summary of tax treatment for contributions, growth, withdrawals across different account types. A handy reference.
Okay. And after maxing out tax-advantaged options,
Taxable investment accounts are the next best bet for more savings. Emphasizes keeping expenses low there too, and benefiting from lower long-term capital gains tax rates by holding stocks over 12 months and choosing low turnover funds.
so even in taxable accounts, long-term low cost still applies. Let's shift back to mutual funds. The book explains them in more detail.
Yes. Describes a mutual fund as pooling money from many investors into one professionally managed account, buying a diversified portfolio of securities, like stocks bonds. Explains the fund manager's role in selecting securities based on the fund's goals.
How buying-selling works.
Right, buying-selling shares happens at the net asset value, NAV, calculated at the end of each trading day. NAV is total fund assets minus liabilities, divided by shares outstanding.
And the prospectus is key.
Absolutely. Highlights every fund must provide a detailed prospectus outlining strategy, fees, risks, etc. Strongly recommends reading it carefully before investing. Shareholders get annual reports listing holdings, but ongoing details might need more research. And reminds send us that dividends interest paid by the fund are taxable to shareholders that year.
So funds offer instant diversification, but you still need to understand the strategy and costs. The book also clearly distinguishes active versus passive index funds again.
Correct. Defines active funds. Manager tries to outperform a benchmark, like Fidelity Magellan aiming to beat the S&P 500. Defines passive index funds. Manager simply replicates an index, like Vanguard 500 Index, matching the S&P 500. Re-emphasizes index funds' key advantage, much lower fees.
And as we heard, lower fees are critical. The book also seems skeptical about picking winning active managers consistently.
Very skeptical. States extensive academic research over decades has failed to find any reliable way to predict future top managers.
Really? No secret sauce.
Basically, no. Research leads to two main conclusions. One, low-fee funds have a statistically higher chance of outperforming high-fee funds long-term. Two, past performance after factoring out fees is not a reliable predictor of future success.
So relying on those historical star ratings might be misleading if you ignore fees.
Precisely. The book even includes a figure directly comparing index funds versus active growth income funds over 10 years ending DSO2.
And the index fund did better.
Showed higher return and lower expenses. Mentions similar comparisons for mid-cap and small-cap funds point the same way. And for listeners wanting specific low-fee options, a table lists examples across various market segments: total U.S. stock, large cap, small cap, international, even REITs with symbols and low fees.
That's incredibly practical info for listeners wanting to act on this. Now, the conversation naturally moves to bonds, another key part of diversified portfolios.
Yes, includes a section explaining bonds and bond funds using a bond matrix chart.
What does that show?
Illustrates the risk-return relationship. Longer-term bonds generally offer potentially higher returns than shorter-term ones, but have more interest rate risk. Their value fluctuates more with rate changes.
Makes sense. What about credit risk?
Describes credit risk, the chance the issuer defaults. Explains the spectrum. Low-risk government bonds, investment-grade corporate Yankee bonds, up to higher-risk, high-yield junk bonds. Notes, while most junk bonds are repaid, the higher default risk justifies their higher potential return.
The classic risk-reward trade-off again. The book introduces building a bond ladder. What's that strategy?
A simple portfolio strategy involves buying individual bonds with equal amounts invested, but staggered maturity dates. Say 1 year, 2 year, 3 year, etc., maybe up to 5 or 10 years.
Okay, and then?
As each bond matures, you get your principal back. You then reinvest that principal into a new long-term bond at the far end of your ladder. The key factor is the yield to maturity, YTM, the total return expected if held to maturity.
Sounds like a sensible way to manage interest rate risk and get predictable income as bonds mature. What about bond funds instead of individual bonds?
Makes an interesting point. It says professionally managed individual bond portfolios can often outperform bond funds long-term, mainly due to the typically higher fees in bond funds.
Fees again.
Cites an average bond fund fee around 1% then, but highlights low-cost alternatives. Vanguard bond funds, bond index funds, including Treasury-focused ETFs. Includes tables recommending low-fee bond funds across various types. Treasury, total bond market, short and intermediate long-term, inflation-protected, 2 IPS, corporate with symbols, and low fees.
Good options listed.
For managing individual bonds yourself, it recommends sticking mainly to the most liquid, easily accessible ones. U.S. government treasuries, which can be bought directly. Cautions against high brokerage commissions if buying through a broker.
So even with bonds, keep fees low. Let's briefly revisit Social Security. After discussing challenges earlier, how should we factor it into retirement income planning?
Right. Having given the outlook, it reiterates the risks and uncertainties. Suggests current near retirees should likely get full benefits, but emphasizes baby boomers and younger generations will likely face reduced benefits and/or a higher retirement age.
So don't count on 100% of projected benefits if you're younger.
Exactly. It provides estimated potential benefit cut percentages and retirement age increases based on age group, suggesting younger workers should discount official projections more significantly in their planning.
So prudent not to rely too heavily on Social Security, especially if you're years away. What about traditional defined benefit pensions?
Explains that in those, employer contributions are based on actuarial assumptions, and the company funds any shortfalls. Briefly describes payout categories: flat, unit, variable benefit. Importantly, notes these plans are generally federally insured by the PBGC, offering protection if the employer's plan fails.
That federal insurance is a big safety net. Now, how does the book say to view Social Security and pension income alongside our investment portfolio?
Advises treating anticipated income from Social Security and defined benefit pensions separately from your core investment portfolio.
Why separately?
Mainly due to the uncertainty around future Social Security benefits. Cautions against just thinking of them as bonds with a fixed return, because future benefits aren't guaranteed and will likely change. To be conservative, keep these income sources distinct from your managed investments.
Makes sense given the uncertainties. Beyond these traditional sources, any other potential retirement income streams the book mentions?
Yes, briefly touches on several others. Selling a business you own, notes low success rates for family succession, importance of exit strategy, rental real estate, potential income tax, benefits diversification, but also risks like vacancies, tenants, illiquidity.
Okay.
Partnerships, active versus passive limited, family limited partnerships for succession estate tax, stock compensation from employer, cautioning strongly against holding too much company stock due to risk references, and runs to just maybe 10% or less is prudent.
Diversify away from company stock.
Right. And finally, briefly mentions home equity and valuable collectibles as potential capital sources if needed.
So various assets could play a role. Now, for long-term planning, realistic market expectations are crucial. What guidance here?
Absolutely. Emphasizes effective retirement management requires understanding past performance to form realistic future expectations. Highlights the 25 years before 2003 were unusually profitable, unlikely to be repeated exactly.
Don't expect the boom years forever.
Right. Notes long-term market risk tends to be more stable than returns, and the basic principle: Higher risk investments should yield higher returns long term to compensate for that risk.
So probably wise not to bank on consistently super high returns like some past periods. What about using risk to forecast future returns?
Explain, since market risk is relatively constant long term, it can be used to forecast expected rewards, the risk premium. Introduces the capital asset pricing model, CAPM, as the financial equation used for this without getting into the math details. States T-bills are considered risk-free. Their long-term return forecast around 1% above inflation. Other investments' expected returns can be estimated by adding a risk premium, calculated by CAPM based on their risk level, to that T-bill rate.
So a framework for thinking about future returns based on risk. What are the long-term economic drivers of stock and bond returns?
For stocks, while short-term sentiment causes volatility, long-term returns are ultimately driven by underlying economic growth. For bonds, long-term return driven by interest payments, reinvestment of interest, changes in inflation, and changes in credit risk. Emphasizes the inverse relationship between inflation and bond prices. Inflation up, existing bond prices down, vice versa.
Understanding those fundamentals is key for realistic expectations. Now, the book strongly emphasizes strategic asset allocation again, mentioning modern portfolio theory,
Yeah.
MPT. What's the core MPT idea for retirement?
MPT stresses that by strategically combining different asset classes in one portfolio, you can potentially get a better risk-adjusted return than with any single asset class alone.
Better return for the same risk or lower risk for the same return?
Exactly, through smart diversification. Uses historical data, S&P 500 and intermediate bonds, 7302, to show how a stock bond mix could have delivered better returns with lower risk than 100% stocks or 100% bonds. Calls this the MPT advantage. Includes a chart showing how adding bonds to an all-stock portfolio rapidly reduces risk without sacrificing much return initially.
So the whole is greater than the sum of parts for a diversified portfolio.
Precisely. Also discusses benefits of low or negative correlation assets moving opposite ways.
Like stocks and bonds sometimes do.
Right. Including negatively correlated assets helps smooth portfolio returns, reduce overall risk, maybe even boost long-term returns. Notes truly highly negatively correlated assets are rare, though. Finally, illustrates how a multi-asset class portfolio, beyond just stocks bonds, might offer even higher potential returns for a given risk level. But reiterates, proper initial allocation and disciplined rebalancing are key to managing it effectively long-term.
All this theory is helpful, but what practical, concrete steps does the book recommend for actually starting to save and invest?
Suggests saving at least 10% of salary into an employer plan if available, pre-tax ideally. If no employer plan, set up automatic withdrawals to a personal IRA.
Start small if needed.
Yeah, if 10% is too much initially, start lower and increase the percentage with each raise until you hit at least 10%. If you have an employee stock purchase plan with a discount, generally take full advantage, sell after vesting, then reinvest proceeds more diversely. And carefully weigh pre-tax versus Roth IRA benefits based on your situation.
So start early, save consistently, grab the match, automate it. What about choosing where to invest, especially if the employer plan isn't great?
Cautions against expensive small employer plans, especially without a match. If your workplace plan has high costs and lacks low-cost index funds, recommends maybe foregoing it beyond the match and opening an IRA with a low-cost provider like Vanguard instead. Strongly advises against investing IRAs with commission-based advisors pushing high-fee products.
Keep fees down. That message is loud and clear. What kind of investment return expectations does the book deem realistic for long-term planning?
Acknowledges achieving maybe 5% consistent annual return might be reasonable long-term in a diversified portfolio. But aiming for 10% plus usually requires significantly higher risk, maybe not right for everyone, especially nearing retirement.
Okay.
Based on its analysis, suggests a well-diversified portfolio might reasonably expect long-term average annual returns around 6.5% to 7.5%, depending on your risk tolerance.
So important to have grounded expectations, not count on double digits year after year. Risk tolerance is obviously key. How does the book address figuring out the right risk level, especially for early savers?
Argues young people don't necessarily need to take excessive risk early on to build wealth long-term. Says most wealth accumulation problems actually stem from taking too much risk at some point, leading to emotional mistakes.
Like panic selling.
Exactly. Emphasizes knowing your personal risk tolerance, your comfort with potential losses. Introduces doing a stress test on your proposed portfolio.
How does that work?
Simulating how your portfolio might perform in a big downturn, like a 30% stock market drop, to gauge your likely emotional reaction. The key takeaway: Your chosen allocation must be one you genuinely believe you can stick with through all market conditions, good and bad.
That ability to stay the course, not make rash moves in turbulence, is crucial. What about folks stuck in employer plans with bad, high-cost options?
Advises employees in such plans to proactively ask their employer to add low-cost index fund options. If that fails, suggest exploring if the employer might switch providers to one with better, cheaper choices. Specifically warns against switching to insurance or brokerage plans pushing high-cost stuff.
Any other recourse?
As a last resort, mentions filing a Department of Labor complaint about the employer's fiduciary duty to offer prudent, cost-effective options, but acknowledges potential unintended consequences.
So worth being proactive and advocating for better options. The book seems consistently strong against the idea that average investors can beat the market by picking stocks or active funds.
Absolutely. Explicitly warns early savers against thinking they can reliably beat the market through stock picking or choosing winning active funds. States individuals generally lack the superior info, resources, and skill needed for consistent outperformance.
But maybe try with a small amount.
Doesn't discourage young people from experimenting with individual stocks if interested in understanding the risks, but strongly suggests any above-market gains are far more likely due to luck than skill.
So for most of us, diversified, low-cost, passive is likely the smarter long-term strategy. What key principles does the book highlight specifically for early savers?
The chapter summary for them includes: start saving early and consistently, increase savings with raises, maximize employer match, compare account options for best tax advantages, Roth versus traditional versus high-cost employer plan after match, invest in low-cost, diversified options like index funds, understand and respect your risk tolerance, use stress tests, rebalance annually. Consider saving early for kids' education, too.
Really solid, actionable guidelines for starting out. The book then shifts to managing wealth in midlife. What's the main focus change then?
Explains by mid-career, focus shifts from just establishing career income towards actively, strategically managing the wealth already accumulated in retirement accounts, which ideally should be significant by now.
Actively stewarding what you've built, thinking more about retirement ahead.
Right.
How does it suggest estimating retirement expenses?
Suggests for most, overall expenses likely decrease somewhat in retirement. Lower taxes, no high savings rate needed, maybe fewer dependents.
But some costs might go up.
Right. Wisely notes travel, leisure, and especially healthcare might increase. As a general rule of thumb, provides the guideline that around 80% of current pre-tax income should sustain a reasonably comfortable retirement lifestyle for most.
A helpful benchmark. It also mentioned lower taxes and reduced savings needs contributing to that 80% guideline.
Yes. Highlight stopping work means lower income taxes, federal, state. No more Social Security, Medicare, payroll taxes. Retirees generally don't need to save for retirement anymore, though some continue as an inflation hedge. And retirees often adopt cost-cutting habits. The 80% target factors these in.
Now, what are the 6 key steps the book outlines for managing wealth effectively in midlife?
Presents a 6-step process. 1. Estimate annual retirement expenses carefully, direct list or indirect percent like 80%.
Sure.
Estimate retirement income sources like Social Security, suggesting those in 40s, 50s, discount official estimates 15-25% due to potential future cuts, and pensions, calculating present value inflation. 3. Assess current wealth and plan future savings, focusing on retirement assets. 4. Update the required rate of return your investments need to hit goals fill income gap. 5. Find the optimal investment mix using market forecasts, aiming for conservative allocation meeting return goal with least risk. 6. Ensure allocation doesn't exceed risk tolerance using stress tests.
Seems very logical and comprehensive for mid-career folks planning ahead. The book even gives an example of calculating the required nest egg.
Yes, clear example. Needs 22-hour your expenses, today's dollars. Multiplies by 22.5, inverse of 4.5% withdrawal rate, gets target $495K, rounds to $500K, then stresses adjusting this for inflation until retirement. Uses 3% average inflation example. For a 45-year-old, 20 years to retirement, shows compounding the $500K by inflation to get the inflation-adjusted savings needed then.
So projecting future needs and future dollars is key. What kind of portfolio allocation does it suggest for midlifers?
Using its realistic market expectations data. Gives an example, portfolio for maybe 6.75% long-term return with moderate risk, 40% total U.S. stock index fund, 50% total bond market index fund, 10% high-yield corporate bond fund. Mentions potential for more diversification, international, value, REITs, emerging market bonds, depending on risk tolerance goals.
A diversified, balanced approach. Finally, the book focuses on the critical pre-retirement and initial retirement phases. Key considerations then.
This chapter covers the 5 years before retirement and the first few years after. Notes main pre-retirement concern is, have I saved enough? Defines retirement period, for the book, as from retirement day until significant health decline. Outlines 6 steps for pre-retirees, similar to midlife but heightened focus on the transition. 1. Refine retirement income needs estimates. 2. Refine income estimates, Social Security pensions. 3. Update current savings value and future contribution estimates. 4. Update required rate of return needed. 5. Update investment strategy allocation. 6. Crucially, reduce portfolio risk as soon as practical.
Makes sense. Nearing the finish line, preserving capital becomes more vital. What changing priorities typically emerge in pre-retirement?
Suggest people at this stage focus less on career possessions, more on ensuring a comfortable, secure retirement, pursuing interests without financial stress. 2 key questions emerge. How much can I safely spend annually without outliving savings? And where will I live? Also points out unanticipated expenses like grandparents becoming primary caregivers, which can significantly increase costs.
Those unexpected family needs can really impact plans. The book also details Social Security for spouses and pension payout options.
Yes, explains spousal Social Security eligibility reduced benefits from 62 even without own work history, based on working spouses benefit, potentially up to 50% of working spouses benefit at spouse's full retirement age, 65, 67. For pensions, explains difference between single life annuity, bigger monthly payment stops at death, versus joint and survivor annuity. Smaller payment continues for surviving spouses. Stresses carefully considering these options.
Crucial decisions on receiving those income streams. It also revisits creating a pre-retirement net worth statement. Focus, then.
Emphasis is listing all assets, categorizing as income producing or convertible to cash. Ideal scenario. Draw retirement income mainly from retirement accounts income investments, not liquidating essential assets.
And updating the required rate of return for pre-retirees. How's that illustrated?
Here's an example. Couple needs $22 a year, today's dollars, multiplies by 22.5 for 4.5% withdrawal. Then adds 15% for inflation over the next 5 years. Gets $570K target nest egg in future dollars. Explains the 22.5 multiplier relates to a sustainable 4.5% withdrawal rate, discussed later.
Projecting needs, ensuring the nest egg can sustain it. It also briefly mentions Social Security taxation again. Can be a surprise.
Yes, explains. Social Security benefits are subject to federal income tax based on provisional income, include AGI, tax-free muni interest, and filing status. Refers to a 2003 table with thresholds. Mentions some states also tax Social Security as ordinary income.
Important to factor those taxes into planning. It also discusses the Social Security earnings test, a disincentive for part-time work.
Yes, explains working part-time between 62 and full retirement age can reduce your Social Security benefits based on an earnings formula. Can even wipe out the benefit temporarily. Expresses concern this discourages experienced people from productive part-time work.
Seems like a potential drawback. Healthcare costs are a huge concern. What aspects does the book cover?
Briefly explains Medicare Part A, hospital, and B, medical. Highlights need for Medigap, supplemental insurance, to cover costs. Medicare doesn't. Mentions standardized Medigap plans, AJ. Addresses long-term care planning, stressing Medicare, Medigap don't cover most long-term care, nursing home, in-home. Discusses who might not need separate LTC insurance. Wealthy might self-insure. Primary LTC insurance goal. Fund 2 residences if one spouse needs facility care. Notes age as main cost factor. Age 55, good time to shop. Recommends inflation protection rider. Suggests consulting fee-only planner for unbiased advice. Vital considerations for later life security. What about handling existing retirement accounts like 401ks at retirement? Discusses options for defined contribution plans. 401k, 403b, 457. Roll into an IRA rollover. Leave assets and plan if allowed. Or cash out, least desirable due to taxes penalties. Notes penalty-free taxable distributions usually start at 59.5. RMDs required at 70.5 based on age. Assets start around 4%. Mentions restrictive exception for pre-59.5 penalty-free withdrawals. Needs tax advisor.
Crucial to understand rules taxes when accessing funds. What about spending in later retirement years?
Offers interesting advice for retirees. Around age 75, finding expenses decreased, assets still growing. Suggests consider increasing annual withdrawal rate. Recommends 6% plus, quotes, Jack Bogle. Addresses reluctance some older retirees have spending down savings, wanting to leave inheritance.
Delicate balance. Enough to last versus enjoying savings. The pre-retiree chapter summary. Key takeaways.
Summary reiterates. Realistically estimate income needs. Reduce investment risk nearing retirement. Understand Social Security pension options. Consider healthcare LTC needs. Plan for retirement account distributions.
Valuable reminders for that stage. Finally, a chapter on experienced retirees' issues later in retirement.
Focuses on issues when others might get involved in finances. Major theme. Putting your affairs in order emphasizes having essential legal docs. Will, trusts, power of attorney, knowing where they are, keeping updated, ensuring assets correctly titled, beneficiaries current. Briefly touches on gifting strategies, reduce estate taxes, consult attorney. Mentions generation skipping trusts, GSTs, for grandkids, can reduce estate taxes, but own needs come first.
Planning for asset transfer, ensuring wishes documented, also discusses preparing people around you.
Yes, strongly advises choosing a trusted person in advance, spouse, sibling, relative, to manage affairs if you become incapacitated. Stresses this person needs to become fully aware of finances early on. Cautions against letting well-meaning but financially unskilled family, like adult kids overestimating skills, take control. Gives examples of losses from bad choices.
Delicate family situation presents hiring a professional advisor as an option, especially later.
It does. Highlights potential benefits. Professional plan formulation, implementation, monitoring, modification, added benefit. Advisor can educate kids on sound investing. Acknowledges advisors don't guarantee superior returns, but offer other valuable service support, especially later in life. Notes fees vary, 0.2% to 2.0%. Recommends thorough research, suggests Vanguard website for guidance on selecting one.
Finding someone trustworthy, competent, with comfortable fees. The Experienced Retiree Chapter Summary. Key points.
Summary emphasizes: 1. Make comprehensive list of all assets, titles, contacts. 2. Ensure legal docs, will, trusts, POA, in order. 3. Appoint a financial fiduciary. 4. Educate helpers on finances wishes.
Practical, important steps for secure later years. The book also has appendices.
Yes, Appendix A briefly covers saving for higher ed. 529 plans, Coverdell ESAs, UGMA GMA notes potential financial aid impact. Offers advice. Parents, grandparents shouldn't promise full cost, encourage student responsibility. Appendix D is a glossary of key financial terms, diversification, index risk, etc. Also a partial index and info about the author, Richard Ferri, and his other books.
It certainly sounds like Protecting Your Wealth in Good Times and Bad, despite being from 2003, offers a ton of valuable foundational knowledge for anyone serious about long-term financial security and retirement.
Absolutely. The core principles: save diligently, invest wisely, avoiding common pitfalls, focus on low costs and diversification, understand life stages. They remain incredibly relevant. Timeless, really.
So, to briefly summarize our deep dive into this insightful book, it really underscores the critical importance of becoming an informed investor, avoiding those emotionally driven decisions, diligently keeping investment costs way down, building a well-diversified portfolio that fits you, your risk tolerance, your time horizon.
Right, and engaging in thoughtful planning for the long haul across all the different stages of your financial life.
It also gives that sobering but important look at Social Security realities and potential challenges.
And the huge impact our own behavioral biases can have on our investment choices and, ultimately, our financial outcomes.
Precisely. This deep dive has given a solid overview of the key insights from Protecting Your Wealth, but we strongly encourage you, our listeners, to maybe explore the source material further yourself.
Yeah, definitely. And really think about how these enduring principles might best apply to your own unique situation and your long-term goals.
And on that note, here's our final thought-provoking question for you to mull over. Given all the valuable info we've unpacked today, what's one immediate, concrete step, maybe even a small one, that you can take right now
Could be anything.
to either reevaluate your current retirement savings plan or just begin actively building a more secure financial future for yourself?
That first step could be super simple, like taking 5 minutes to look up the expense ratios on the funds in your 401k.
Or just thinking more deeply, is my portfolio really as diversified as it should be?
Exactly.
We sincerely hope this deep dive has given you some really valuable food for thought, maybe even inspired you to take that first step, whatever it is.
And hey, if you have specific articles, research papers, even whole books you'd like us to explore in future deep dives,
Please send them our way. We're always eager to dig into new topics and help you on your journey of learning and making informed decisions about the things that matter most. Thanks for joining us for this deep dive.